Hey, what's happening, guys? Welcome back to the intensive review. Probably the most important topic in all three levels because of the impact it has in level 1, level 2. I mean, financial reporting and analysis, you're looking at a minimum of 20% of the exam. Okay, but that's kind of misleading because there's a ton of overlap, obviously, with corporate finance, a lot of overlap with the debt, and a lot of overlap with equity as well. So obviously, you guys want to rock the financial reporting and analysis. So you may have hated accounting, and that's why you went into financing. But for the most part, this is not the stuff you hated. This is not bookkeeping, the debits and credits, as you know. This is big picture, understanding, why is it so important to understand the financial statements, and how does that help us value an asset? So really what I want you to think about through this entire process is, for everything we review, how's it going to help us forecast future cash flow? So how's it going to help us forecast whether it be dividends, interest, whether it be proceeds on sale or maturity value, whatever it may be. And then we want to understand how the financial statements help us assess risk, required rate of return, the discount rate that we're going to use to take our future cash flows, discount them back to today to come up with our intrinsic value in our opinion. And then we're going to look at growth. And then we're going to see how growth plays a part in all this and how growth can somewhat mitigate risk, increase our future cash flow. So big picture, that's what we're looking to do. Okay, now some of these readings, for the most part, if it's primarily terminology or definitions, I'm just going to refer you back to the 11th hour guide if you need a greater explanation. We're going to focus in on the more math intensive, obviously the things that are heavily tested. But before we do that, just logically, we're going to go through reading by reading. So we're going to start with reading 22. Now, we're going to make some notes together, okay? So, first thing we want to do is the primary financial statements. And really, at the end of the day, what's the role of the balance sheet, the income statement, the statement of cash flow, and the statement of changes in stockholders' equity. Okay, so what's the role of these primary financial statements? So the key thing is we want to provide information that's useful, relevant, reliable to help people make economic decisions. Should I buy your stock or not? If I'm going to lend you money, what should the cost of borrowing be? So what do we get from the balance sheet? The balance sheet is a unique financial statement because it's as of a particular date. So this is the only one that's as of a particular date. So the goal when we look at the balance sheet is not to determine the fair market value of the equity. For the most part, the assets are not on the books at fair market value. So the assets are on the books in a variety, measured in a variety of different ways. So really, the balance sheet's going to help us assess financial risk, the risk of financial distress. So that financial risk could be short-term in nature, liquidity. Are we liquid enough to pay our debts as they become due? Or more long-term in nature, solvency. How did we raise our capital, our debt versus our equity? Now, the income statement, the statement of cash flow, and the stockholder statement of changes in stockholders' equity, these all represent performance, but over a period of time. So obviously, the income statement is going to help us determine profitability. So obviously, we want to determine the financial performance of the company. So really we want to look at, are the assets being turned over to create revenue? So that's step number one. Are those assets being turned over to create revenue? And then can that revenue exceed the expense incurred to generate the revenue to in turn generate profit? So we want to look at the turnover, the profit margin, amongst other things. But big picture, we want to determine the performance of the company over a period of time. Now, the statement of cash flow. A statement of cash flow is going to help us determine a variety of different things. So, very important for valuation, because you're going to see in a lot of the valuation models that we use, it's heavily dependent upon a starting point, cash flow from operations. But can we generate cash from our core business? So we want to understand the relationship between the cash generated from the core business and the net income that's reported on the income statement. It's going to help us better understand the business and the financials and the operating risk. We want to look at growth potential, cash flow from investing. Are they reinvesting in the business? and how they're raising their capital, cash flow from financing. So the statement of cash flow is going to be very useful in assessing performance, growth potential, risk, required rate of return, and then ultimately value. A statement of changes in stockholders' equity is going to help us understand why did the financial position of this company. So we want to know in that statement of changes in stockholders' equity, what made our equity go up or down? So it's going to explain to us why equity went up or down. Now, there's two major sources of equity. There's contributed capital. I'm not very impressed if your equity went up because you added partners. Okay, you're going to be diluting my earnings per share. And then there's earned capital. And that earned capital, internally generated, this is a sustainable source of capital. So we want to look at that statement of changes in owner's equity to understand why it is that equity changed over time. Is it from internally generated capital, or did we add more partners, whatever the case may be? Now, not only are we concerned with the primary financial statements, but we need to understand the footnotes to the financial statements. That's an integral part of financial reporting. Okay, the financial statements, the footnotes are audited, so they're not an option. Okay, it's going to help us understand the methods of accounting, the assumptions used by management, the accounting estimates. So we want to understand by looking at the footnotes, really, quality of earnings. We wanted to be able to determine whether the company is being relatively conservative or aggressive. So that's a key component when we assess the primary financial statements, that we understand the footnotes to the financials. So the footnotes are going to be very important. Now,